Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, what if I told you that right now some of the smartest money on Wall Street is aggressively pouring billions of dollars into an active war zone while, simultaneously treating perfectly healthy, brand new U.S. financial products like toxic waste?
I mean, it sounds completely backward, doesn't it? But
Yeah.
that is exactly what the data is showing us right now.
Yeah.
We're seeing this massive disconnect between what things are called on paper and how global capital is actually treating them behind the scenes.
Right. And if you're an everyday American investor, maybe managing your own retirement account or, just testing the waters on a brokerage app, understanding the disconnect is everything.
Oh, absolutely. It's
I
crucial.
mean, especially as American investors navigating the economic landscape right here at home under the current Trump administration, it's vital to see how these massive international ripples eventually crash onto our shores and affect our domestic portfolios.
Yeah, the global economy is just too interconnected to ignore.
Exactly. So our mission today is to look under the hood of three surprising shifts in the global markets. We're going to explore how the rules of survival have completely changed for the funds we buy, how smart money is, basically slicing up entire sovereign nations, and how a country's economic struggles can bizarrely make it a top pick for global banks.
It's a really fascinating lineup of data to go through.
Okay, let's unpack this. And I want to start with something that is supposed to be the most boring, predictable investment on the planet, the ETF.
Right, the exchange traded fund. For years, I mean, the story we've all been told is that ETFs are the ultimate set it and forget it tool, you know?
Yeah, exactly.
Like you want to own a piece of the S&P 500 or the tech sector without picking individual stocks, you just buy an ETF.
Right, a basket of assets.
Exactly. Simple, safe, stable. But when you look at the recent analysis, the underlying reality of the ETF industry right now looks less like a stable vault and a lot more like a graveyard of fast-failing Silicon Valley startups.
Yeah, the failure rate absolutely blew my mind when I was reading through these reports.
Kind of staggering, isn't it?
It really is.
Uh,
I was looking at a recent Reuters analysis from late 2025, and it showed nearly 800 new ETFs were launched in just the first 9 months of the year,
wow.
which, by the way, that already surpasses the 746 launched in all of 2024.
Right, so a massive acceleration.
Just a staggering amount of new products flooding the market. But the catch is, they are dying incredibly fast.
Yeah, they really are.
Like Morningstar data tracked 146 active ETFs just closing up shop and liquidating in 2025. And the one thing almost all of those dead funds had in common was their size.
Hmm.
They all had under $25 million in total assets.
Which, is a tiny, tiny footprint in the financial world. And it really highlights how the fundamental rules of this industry have just completely inverted.
How do you mean?
Well, 10 years ago, the game was all about product innovation. If a brilliant financial mind built a highly efficient, unique index, the capital would naturally find its way there. It was very much a, if you build it, they will come mentality. Today, innovation is entirely secondary. The only thing that actually matters is distribution and scale.
Yeah, I was trying to wrap my head around this, and the best analogy I could come up with is that launching an ETF today is exactly like opening a trendy food truck in a major city.
Oh, I like that.
Right? Because of new technology and, relaxed regulations, the barriers to entry are basically gone. Anyone can buy a truck, paint a flashy logo on the side, and invent some wild, innovative fusion taco recipe.
Sure.
But, and this is the key, if you cannot immediately secure a prime parking spot right outside of massive corporate office building to guarantee foot traffic on day one, you are going out of business in 3 months.
Yep.
It does not matter if you have the best taco on earth. If you don't have distribution, you die. So if the overarching industry is booming, why are so many individual funds failing so fast?
What's fascinating here is the brutal math behind that food truck analogy. Running an ETF has fixed costs.
Okay.
You've got compliance fees, exchange listing fees, legal costs, all of that. And ETF providers make their money by charging a microscopic management fee. a tiny fraction of a percent of the money invested in the fund.
Right. The expense ratio.
Exactly. So if you don't hit a critical mass of foot traffic, which, looking at the data, is usually well over that $25 million mark, the tiny fees you collect don't even cover your basic legal and compliance bills.
Wow. So you're just operating the law.
You bleed cash daily.
So the fund manager eventually just has to throw in the towel, close the fund, and return whatever money is left to the handful of investors who actually bought it.
Exactly. And because the threat of death is so high, we are seeing fund managers resort to what I can only really describe as desperate marketing stunts just to get noticed.
Oh man, the stunts are wild. I saw the SEC filings from firms like REX Shares and Tuttle Capital.
Yeah, those are prime examples.
They are actually filing paperwork to launch 2 times leveraged ETFs for companies like SpaceX and Anthropic. And for anyone listening, neither of those companies are even publicly traded yet.
Right, no IPO in sight.
Haven't had an IPO. That's crazy.
We should probably break down what a leveraged ETF actually is mechanically, because it highlights just how extreme this stunt is.
Yeah, let's do an ELI 5. Explain it like I'm 5 on leveraged ETFs.
Sure. So think of a standard ETF as a regular car driving down the highway.
Okay.
It goes up when the market goes up. It goes down when the market goes down. Very straightforward. A 2 times leveraged ETF uses financial derivatives, basically really complex debt contracts, to strap a massive rocket booster to that car.
Sounds dangerous.
It is. If the underlying stock goes up 1%, the leveraged ETF goes up 2%. But if the stock goes down 1%, the ETF crashes by 2%.
Ouch.
Yeah. It is highly volatile, highly risky, and meant pretty much only for short-term day trading.
So these firms are trying to strap financial rocket boosters to companies that don't even have public stock to trade yet. Why on earth would they waste money filing the paperwork for that?
Because it's a land grab, they want to be the very first name that pops up on a brokerage app the second those companies eventually go public.
Oh, wow.
It's pure clickbait for retail investors. They're trying to manufacture that foot traffic through sheer hype.
But I have to ask, if distribution is the only thing that keeps you alive, why are the massive Wall Street giants even bothering to launch new products? I mean, why don't they just use their endless billions to build better distribution networks?
Well, they realized that building a loyal audience from scratch takes years, even for the big guys. So instead of building, they're simply buying the food trucks that already managed to find a good parking spot.
Oh, that makes sense.
We're seeing a massive wave of mergers and acquisitions, or M&A, in the ETF space right now. Look at Goldman Sachs. They recently dropped roughly $2 billion to buy a firm called Innovator Capital Management.
I saw that. Innovator had a lineup of what they call defined outcome ETFs, right?
Oh,
over 150 of them, I think.
Right, 159 funds and about $28 billion in assets. And to explain that concept simply, a defined outcome ETF is sort of like putting bumpers in the gutters at a bowling alley.
Okay, I like that.
It uses options contracts to guarantee that even if the stock market crashes, you won't lose more than a certain percentage of your money.
Right.
The trade-off, though, is that it also caps your upside. You can't roll a gutter ball, but you also aren't allowed to bowl a perfect game.
It's essentially a shock absorber for your portfolio.
Precisely. And Innovator had successfully grown this idea to hold tens of billions of dollars. So Goldman Sachs looked at that and realized, we could spend half a decade trying to copy this and fight for attention, or we could just write a $2 billion check and instantly own an audience that is already loyal.
Wow.
We saw the exact same logic when a massive bidding war erupted for Janus Henderson recently. Over $8 billion there. Wall Street is just buying out the survivors.
So for you, the everyday American investor, the takeaway here is a total mindset shift. You can no longer look at an ETF ticker symbol and just blindly assume it's a permanent piece of market infrastructure that will be there when you retire in 30 years.
Absolutely not.
You have to look at the plumbing. How big is it? Who is backing it? Does it actually trade regularly? Because an ETF isn't just a basket of stocks anymore. It is a financial startup fighting a cutthroat battle to keep the lights on.
It really requires you to look past the label.
Yeah.
And that philosophy of ignoring the label and looking at the underlying mechanics is exactly what the smartest global capital is doing on a macro scale, which kind of takes us out of the US ETF market and directly into the Middle East.
Yeah, this was the most counterintuitive data we looked at today. Because we are talking about looking past simple labels, we naturally tend to label entire countries as either good or bad investments based on the news cycle.
Right, especially with geopolitical conflict.
Exactly. But looking at the data, global investors are currently treating Israel not as one unified country, but as two completely parallel economies occupying the exact same geographic space.
And one of those economies is flashing massive red warning lights, while the other is absorbing tens of billions of dollars in premium investment.
Let's look at those red lights first, because the macro economy, the broad, traditional metrics of how a country is doing, looks incredibly rough due to the ongoing conflict.
It really does.
Credit rating agencies like Fitch, they maintained an A rating, but they kept a negative outlook on their sovereign debt, meaning a downgrade is hanging over their heads due to political instability.
Right.
Their central bank had to slash 2026 growth forecasts down to 3.8%, and the finance ministry warned it could even hit 3.3% if the war drags on.
Which is a significant drop.
Huge. Their currency, the shekel, weakened to around 3.1675 against the dollar recently. And the government just passed a massive 699 billion shekel defense budget.
That is the reality of a war economy. I mean, if you were looking to buy a broad index fund that covers the entire Israeli economy, their banks, their retail, their real estate, you are buying all of that friction.
Yeah.
You're buying the inflation, the currency risk, the sheer staggering cost of the conflict.
To me, looking at those numbers as a beginner investor, investing there seems like buying a house with a caving, leaky roof, sitting in a neighborhood that is actively on fire. I wouldn't touch it.
Right.
But then you look at the microeconomy, specifically their technology and cybersecurity sectors.
If we connect this to the bigger picture, capital markets do not possess emotions, and they do not take political sides.
No, they don't.
They operate entirely on the cold mechanics of supply and demand. And despite the macroeconomy struggling, the tech sector in Israel saw over $15.6 billion in private funding in 2025.
That's insane.
Plus over $74.3 billion in M&A activity. You had American giants like Palo Alto Networks dropping about $25 billion to buy the Israeli cybersecurity firm CyberArk. Alphabet scooped up Wiz.
Or just massive, massive deals.
Oh, and defense contractors there, like Elbit Systems, saw a 16% revenue jump. They are sitting on a $28.1 billion backlog of global orders.
Okay, but wait, I have to push back here, because mechanically, I just don't get it. War isn't just a number on a spreadsheet.
No, of course not.
It means disrupted supply chains. It means thousands of tech workers might suddenly get drafted into military service. How does a tech ecosystem even keep the lights on, let alone attract billions from Google and Palo Alto, when the physical realities of the country are so unstable? I mean, how are global investors justifying this?
It's a completely valid question, and the answer comes down to two specific mechanics: the nature of the product and an unprecedented government safety net.
Okay, explain that.
First, think about what these tech companies actually make. They aren't manufacturing physical cars or refrigerators that need to be put on cargo ships.
Right.
They are building cloud-based cybersecurity software and artificial intelligence defense systems. The intellectual property lives on servers in the cloud, not in vulnerable physical factories.
Okay, so the product is digital and geographically insulated. I get that. But what about the funding? Startups need constant cash to survive, and usually venture capitalists run for the hills at the first sign of geopolitical risk.
This is where the local government stepped in with a really fascinating mechanic. The Israeli government realized that if venture capital dried up, their brightest tech minds would just leave the country.
A massive brain drain.
Exactly, a total brain drain. So the government proactively pumped $450 million directly into local venture capital funds.
Wow.
They essentially told the market, we will act as the financial backstop. We will co-invest and absorb the risk so that these startups do not starve for cash while the conflict is happening.
So they built an artificial floor under the tech sector to keep it alive, like putting a state-of-the-art security system in the basement of that leaky house.
Exactly. They ensured the brain trust. And from the perspective of a global corporation in New York or London, they look at that and say, okay, the local government is subsidizing the financial risk, and the product is cloud-based. And more importantly, we desperately need this tech.
Right.
If you are a massive Fortune 500 company, you cannot afford to have your customer data hacked. Regardless of global politics, you need the absolute best cybersecurity software on the planet, period.
So the lesson here for the everyday investor isn't about jumping into foreign markets blindly. It's about nuance. It's using a scalpel instead of a sledgehammer when you read the news.
Very well put.
When you see headlines about geopolitical conflict, your instinct is to assume every asset in that region is toxic. But smart money separates the macro risk of the nation from the micro-technological value that the world actually needs.
They are looking for the bunker inside the storm. And that search for a bunker provides a perfect lens for our final topic today. Because while investors are using a scalpel to find high-tech havens in the Middle East, they are taking a completely different, almost brutalist approach to finding a safe haven in Asia.
And the recent analysis points to a very unexpected winner here: China.
Yeah.
Now, let's be real. If you paid any attention to financial news over the last couple of years, the narrative around China has been entirely focused on their massive real estate collapse and a very weak domestic consumer.
It's been pretty grim news mostly.
Right. Yet, during recent periods of heavy global market volatility, major global investment banks started upgrading Chinese equities, picking them over historically stable neighbors like Japan and South Korea.
It's a major pivot. Looking at the data from March, during one specific volatile stretch, the Korean market plummeted nearly 18%.
Ouch.
Japan dropped roughly 13%. But the Chinese Shanghai index, it only dipped about 6%.
That's a huge difference. And JP Morgan even named China its top market in Asia, while HSBC is maintaining an overweight position. Plus, China's March manufacturing PMI actually rebounded to 50.4, and non-manufacturing hit 50.1.
Right, showing slight expansion.
The analogy I keep coming back to is that investing in China right now is like wearing a thick, heavy rubber raincoat in the middle of a massive hurricane.
Okay, I see where you're going with this.
You aren't comfortable. You definitely aren't having a pool party. But you are a heck of a lot less wet than the guy standing next to you in a t-shirt, which in this case would be Korea or Japan.
That's a great visual.
So what does this all mean? Is China actually fixing its economy, or are they just getting lucky with energy prices?
This raises an important question. Is China actually fixing its deep structural economic issues, or are they just strategically insulated from the current storm? And when we look under the hood, it is heavily leaning toward insulation. They are serving as a relative safe haven right now strictly because they have engineered their economy to be less vulnerable to external energy shocks.
Can we break down that mechanism? How exactly do they build that insulation while tech powerhouses like Japan are left totally exposed?
It all comes down to where you buy your fuel. Japan and Korea are massive manufacturing and tech hubs, but they don't have their own natural resources.
Okay.
They rely heavily on energy flowing out of the Gulf, passing through the Strait of Hormuz, which is a major, highly volatile geopolitical choke point right now.
Oh, absolutely.
If conflict spikes in the Middle East, the cost of oil shipping through that strait skyrockets, which instantly crushes the profit margins of factories in Tokyo and Seoul.
But China saw that vulnerability and spent years diversifying.
Precisely. While the rest of the world was reacting to sanctions and supply chain crunches, China quietly stockpiled massive amounts of discounted crude oil from Russia and Iran via overland pipelines and alternate routes.
Just bypassing the sea lanes.
Exactly. To put it in perspective, the state-owned giant PetroChina recently noted that only about 10% of its oil and gas supply relies on that vulnerable Strait of Hormuz.
Only 10%.
Yeah.
So it's like having a massive private generator in your basement while the rest of your neighborhood is completely dependent on a fragile power grid subject to rolling blackouts.
That's exactly it.
You aren't necessarily richer than your neighbors, but your house is still functioning. That explains why their stock market only dropped 6% while others fell by double digits. Their factories can keep humming on cheaper, stockpiled energy.
It's an incredible defensive advantage on the global stage. However, and this is the massive warning light for anyone looking to invest in Asian markets based on these recent bank upgrades, do not confuse a defensive play with a growth story.
Okay, say more about that.
Because while the outside of the house is weatherproofed, the inside of the house is still dealing with some serious leaks.
Right, and you can see those leaks clearly when you look at their domestic banking sector data.
Oh, definitely.
The massive state-owned banks, which are the absolute bedrock of the Chinese economy, are barely growing. Recent data showed major institutions like the Bank of China and the Agricultural Bank of China seeing profit growth hovering just over 2 or 3%.
Which is incredibly weak.
But the really telling metric was their net interest margins, which have shrunk to incredibly low levels.
Yeah, let's do another ELI 5 here, because net interest margin, or NIM, sounds like awful financial jargon, but it's actually the simplest way to take the temperature of an economy's health.
Yes, please, walk us through it.
Think of a bank like a retail store, but instead of buying and selling shoes, they buy and sell money.
Okay,
They buy money from everyday depositors by paying them a little bit of interest on their savings accounts. Then they take that money and sell it to businesses or home buyers by charging them a higher interest rate for a loan.
makes sense.
The difference between what they pay the depositor and what they charge the borrower is their profit. That is the net interest margin.
So if that margin is shrinking rapidly, what does that actually tell us mechanically about the people living in China?
It tells us that nobody is walking into the store to buy money.
Wow.
The domestic consumer is anxious. The real estate hangover is still very fresh. Businesses aren't taking out big loans to build new factories or expand. Because demand for loans is so incredibly weak, the banks have to continuously slash the price of their loans, their interest rates, just to convince anyone to borrow.
So their profit margins just get completely crushed.
Exactly, because the internal economic engine is sputtering.
Okay, so bringing this all together, when global banks upgrade China to an overweight position, they aren't screaming that China is about to experience a roaring fundamental economic boom.
Not at all.
They are simply making a calculated bet. They are saying, in a world where global energy prices could spike tomorrow and supply chains could snap, China's market is simply the least likely to immediately collapse.
Exactly. It's the heavy raincoat. You don't buy it because it looks good. You buy it strictly so you don't drown in the storm.
Man, this has been such a revealing deep dive into how things actually work under the surface. If we pull all of these threads together, the overarching theme today is that the modern global market is demanding a much sharper eye.
It really is. The simple labels are dead.
Completely. You cannot just buy a standard U.S. ETF and forget it, assuming it's safe.
Right.
Because if it doesn't have the distribution mechanics to survive, it will close its doors in months.
Right.
You cannot look at an entire country like Israel and label it purely as a toxic risk or purely bad for investing, because smart money is ignoring the macro headlines to buy up critical cloud-based technology.
Yep.
And you certainly can't assume a market like China is booming just because its stocks are dropping less than others. In a crisis, being structurally less bad is often enough to attract billions of dollars.
It completely reframes how we should look at data as investors. And I will leave you, the listener, with this final thought to explore on your own. If massive multi-billion-dollar financial products and entire sovereign nations are currently being treated like fast-failing startups or temporary defensive bunkers by the smart money, how should you be stress testing your own personal portfolio against these exact same hidden vulnerabilities?
Oh, that's a great point.
Right. Take a hard look at the investments you consider to be your safe bedrock. Are your safe investments actually safe or just less bad for the moment? What is their hidden point of failure?
That is a phenomenal, provocative question to end on, and absolutely something we should all be asking ourselves as we review our accounts this quarter. Thank you for joining us on this deep dive. Don't forget to subscribe and hit that like button.